$400 billion is sitting on a table. Donald Trump pushed it there with one signature in April of 2026, and almost nobody in the financial media noticed because they were too busy arguing about tariffs and inflation and whatever. Cable news was screaming about that week. While they were distracted, the smart money was quietly moving into a brand new category of medicine that the FDA had refused to touch for 40 years. That door is now open. 3 small biotech stocks tied directly to that executive order moved 20 to 50% the day after it was signed. That was the opening gun. Most retail investors missed it completely because they are always watching the wrong race. This video is going to show you exactly what that race is, who the real runners are, what the math looks like, if this plays out the way the evidence suggests it will, and how to position yourself without blowing up your entire portfolio if you are wrong. Pay close attention. The research in this video would cost you $4,000 to $5,000 to replicate on your own if you had the Wall Street contacts and the time to dig through the trial data, the FDA calendars, and the patent filings. You are getting it right now for free. The only thing I am asking in return is a subscription to this channel. Hit that button, because the next time I cover a move like this, you will want to be here before the crowd arrives. Not after. On April 18th of 2026, President Trump signed an executive order that did 2 things at once. It fast-tracked a brand new category of mental health treatment, and it handed $50 million in federal research funding directly to the companies developing it. Some of the drugs in this category were designated as national priorities, meaning they get priority review voucher status at the FDA. That is not a small thing. That is the government putting its hand on the scale and pointing it directly at these companies. The category is called psychedelic-assisted therapy. Before you roll your eyes, understand that I am not talking about someone eating magic mushrooms at a festival in the desert. I am talking about a synthetic, lab-manufactured version of the active compound administered in a clinical setting, with a physician present under controlled dosing protocols. This is medicine. It just happens to look nothing like the medicine that has existed for the last 4 decades. Here's why that matters. There are 280 million people on this planet living with serious, clinically diagnosed depression. Of those, approximately 85 million do not respond to standard antidepressants. They have tried the pills, they have tried different versions of the pills, they have collected every side effect imaginable and received 0 benefit in return. These are not people who are mildly sad. These are people who are disabled by their condition. Mental health is a leading cause of disability globally. That is not a statistic I made up. That is the documented finding of the World Health Organization, and the system, until very recently, had no real answer for this population beyond handing them another version of a drug that was already not working. Then there is the veteran population, which carries enormous political weight in Washington regardless of which party holds power. Veterans returning from combat with severe PTSD, chronic anxiety, and addiction disorders have been handed the same inadequate pharmaceutical toolkit for decades. Bipartisan legislation in the United States Congress has been specifically addressing this group. When both sides of the aisle agree on something, it tends to move. Add RFK Jr. running the Department of Health and Human Services with an explicit mandate to push alternative and innovative treatments, and you have a regulatory environment that is genuinely different from anything that has existed since before. Most of these companies were founded. Wall Street has done the math on this patient population. The total addressable market for psychedelic-assisted therapy across depression, PTSD, anxiety, and addiction is estimated at $400 billion annually. That is not a speculative number invented by a startup trying to raise money. That is a top-down market sizing exercise done by the analysts at institutions that manage hundreds of billions of dollars in capital. And whether the actual capture rate reaches 10% of that number or 2% of that number, you are still talking about a commercially transformative outcome for any company that gets a single approved drug to market. Before anyone says this is speculation, let me show you the proof of concept that already exists inside a company you have heard of, Johnson & Johnson, the same company that makes baby powder and Band-Aids. Got FDA approval in 2019 for a drug called Spravato. It is an esketamine nasal spray designed specifically for patients with treatment-resistant depression, the same population that every psychedelic biotech in this video is targeting. When the drug launched, the financial media declared it a disaster. The price was $590 per dose. Patients take it twice a week for the first month. The UK's regulatory watchdog refused to cover it. Insurance analysts said coverage would be minimal. The consensus view was that Johnson & Johnson had burned years of research and development capital on a product that would sit on pharmacy shelves, collecting dust. In the first quarter of 2026, that drug brought in nearly $500 million in revenue. That is a single quarter. Year over year, revenue growth came in at nearly 50%. Bloomberg has since called it Johnson & Johnson's blockbuster psychedelic drug. The company is currently guiding toward $5 billion in annual Spravato revenue within the next few years. Every single person who said the market would not pay for this was wrong. Insurance is covering it. Doctors are prescribing it. Patients who had no other options are paying for it out of pocket when insurance does not cover it, because after years of suffering, $590 per dose looks like a bargain compared to a lifetime of disability. This is the proof of concept. This is the precedent. The market exists, the patients are there, the insurance infrastructure is beginning to support it, the regulatory pathway, which was the missing piece for every company not named Johnson & Johnson, is now being opened by executive order and FDA reform simultaneously. You cannot look at a drug doing nearly $2 billion a year in sales and continue to argue that nobody wants to pay for this category of treatment. The data has destroyed that argument completely. Now, here is a limitation of the Johnson & Johnson investment, and this is important. Johnson & Johnson is a company worth hundreds of billions of dollars. Spravato doing $5 billion a year in sales barely registers as a rounding error on their income statement. I bought Johnson & Johnson late in 2024, captured roughly 40% in gains, and sold it, not because the drug failed, but because the math stopped working at that company's scale. When the same revenue lands inside a company worth $1 billion, the math transforms entirely. That is the entire thesis for what comes next. Before I take you through each company, I want to give you the 3 filters I use to evaluate any pharmaceutical investment opportunity. Write these down. Filter 1 is gross margin, which is essentially the profit per sale. For a properly protected drug company, you're looking for 70% or higher. That means for every dollar of revenue, the company keeps 70 cents after the cost of manufacturing and delivering the drug. Filter 2 is patent duration. How many years until a competitor can legally manufacture a generic version and destroy the pricing power? 5 years is not enough to justify the risk. 15 years is a workable floor. Longer is better. Filter 3 is whether the drug is actually on the market and generating revenue. And I am always cautious about companies that are still in clinical trials because the FDA can say no, the trial can fail, and a stock that was trading on expectations can lose 80% of its value in a single session. Selling is good. Trials are risky. Run every company through these 3 filters before you make a decision. The first company is Compass Pathways, ticker symbol CMPs. Compass is the name that comes up first in any serious conversation about this category because they are the furthest along in the regulatory process. Their drug is called COMP360. It is a synthetic version of psilocybin, which is the active compound in what is commonly known as magic mushrooms. It is designed specifically for treatment-resistant depression. Same patient group, same unmet need. The drug is administered as a single dose, and the therapeutic effects are measurable within 24 hours. Their clinical trials have measured durability of effect out to 26 weeks, which is a time frame that no other psychedelic compound in development has attempted to document. The Phase 3 trial data is generally within the range that the FDA accepts for approval and consideration. The expected FDA decision window is late 2026 into early 2027. If that approval comes through, Compass becomes the first company in history to have a classic psychedelic drug approved by the United States Food and Drug Administration. That is a headline that moves institutional money. Now run it through the filters. Gross margin data, not available because the drug is not yet on the market. Patent status. They hold multiple patents covering the formulation, the dosing protocol, and the manufacturing process. But the real-world durability of those patents will only be tested when a competitor tries to copy the drug and a lawsuit gets filed. Are they selling? No. So Compass fails 2 out of 3 filters by the nature of where they are in their development cycle. That is not a condemnation. It is a description. This is a pre-revenue company trading on the probability of an FDA approval that has not happened yet. The stock chart reflects exactly that reality. It ran up to $60 in 2021 on nothing but enthusiasm, collapsed to below $4 as the enthusiasm wore off in the timeline stretch, and is now sitting around $10. That 83% drawdown from peak is not a warning sign. It is a setup. Innovation stocks that survive the trough and begin recovering before the catalyst arrives are historically where the largest returns come from. The second company is Atai Life Sciences, which recently completed a merger with Beckley Psytech and now trades under the combined entity name as ATI on the NASDAQ, where Compass is a single drug concentrated bet. ATI is a platform, but they have 5 separate drug candidates in active clinical development. The diversification matters in biotech because if one compound fails its trial, the other 4 are still in play. One of their compounds, if it works commercially, would not require a clinical setting at all for administration, which is an enormous commercial advantage. A drug you can prescribe without booking a 6-hour clinic appointment reaches far more patients far faster. ATI also holds a stake in Compass and has licensed Compass's drug for certain international territories, which means even if their own pipeline underperforms, they have partial exposure to the leading horse in the race. Peter Thiel, who has been right about more disruptive investments than most fund managers alive today, is a named backer of this company. Through the filters, no meaningful sales yet, 5 separate patent estates which distribute both the protection and the risk and are not currently selling. ATI is a similar size to Compass in market capitalization. It is a more diversified speculation if you believe in the category but want some insurance against a single drug failure. The stock chart tells the same story as Compass. It ran to $23, retraced almost entirely back to its listing price, and is now recovering from a base. Same pattern, same psychology, same potential. The third company is GH Research, ticker symbol GHRS. This is the technology bet. Their entire platform is built around a single compound called 5-MeO-DMT, which is a fundamentally different psychedelic molecule from psilocybin. The key clinical differentiator is duration of effect. A Compass COPM 360 treatment session runs 6 to 8 hours in a clinical environment. A GH Research treatment session, if the drug works as designed, runs approximately 30 minutes. Think about what that means commercially. A clinic that invests in the equipment, the trained staff, and a licensed space to administer these treatments can see 12 to 16 GH Research patients in the time it takes to complete a single Compass session. Throughput is the commercial multiplier in any treatment-based business. Shorter sessions mean more patients per day, which means faster revenue ramp and lower cost per treatment delivered. Through the filters, no sales yet, single compound with single mechanism, which is the highest risk profile of the 3 and not currently selling. GH Research is the most concentrated bet in this group. It is also the most asymmetric, if the 30-minute session model disrupts the longer format clinical approach that Compass is building toward. If you are building a position across this category, these 3 companies each represent a different risk and reward profile within the same macro thesis. Let me show you the math that makes this category worth serious attention. Johnson & Johnson is currently guiding toward $5 billion in annual Spravato revenue. Their market capitalization is somewhere north of $400 billion, so $5 billion in drug revenue represents slightly over 1% of their total company value. That is why the stock barely flinches when the drug posts record quarters. It is simply too small relative to the size of the machine it is sitting inside. Now take that same drug revenue and put it inside Compass Pathways. Compass currently trades at a market capitalization of roughly $1 billion. If Comp 360 achieves even half of what Spravato is doing today, which is approximately $1 billion in annual revenue, and if Compass trades at a reasonable 5 to 10 times revenue multiple, which is the standard valuation range for a patent-protected pharmaceutical company with high gross margins, then you are looking at a company valued at $5 to $10 billion. That is a 4 to 8 times return from where the stock is trading right now. If Compass were to approach Johnson & Johnson's current numbers, mathematics would stop being a model and start being a number that most people would not say out loud because it sounds irresponsible. I am not forecasting that. I am not promising that. What I am telling you is that the mathematical structure of the opportunity exists, it is not fabricated, and it is based on revenue that is already happening at a competitor inside the same patient population with the same payer infrastructure. The conditions required for this scenario to play out are FDA approval, successful commercial rollout, no catastrophic safety surprises that pull the drug off the market, and no equity dilution so severe that it wipes out the per-share value even as the company grows. Those are not trivial conditions. Every one of them represents a real risk. But the scenario is not speculative in the sense of being invented. It is speculative in the sense that the outcome is uncertain, which is different. The quantum computing sector gave us a framework for this. Rigetti Computing was a company that most people ignored for years while it sat in the trough of the innovation cycle. The thesis was right. The timeline was long, and the people who bought at the bottom when it was boring and nobody was talking about it made returns that would embarrass most hedge fund managers. The psychedelic therapy sector is at a structurally similar point in its cycle right now in 2026. The proof of concept exists, the regulatory door is open, the patient demand is documented and enormous, the companies are still small enough that a genuine commercial success transforms the stock in a way that is simply not possible at Johnson & Johnson's scale. The window between now and the first FDA approval in this category is the window. Once the approval comes and the headlines run, the move will already have happened for a significant portion of the return. None of what I just told you changes the fundamental nature of what these investments are. They are calculated speculations. They are not core portfolio holdings. They are not the kind of positions you build retirement security on. They are asymmetric bets that you make with money you can afford to lose in its entirety, size in a way that the loss does not change your financial trajectory in any meaningful way. Here's the number: 1 to 3% of your total investable portfolio, spread across however many of these 3 companies you choose to hold. Not one company. Not all in. 1 to 3% total exposure to this category. Why that number? Because if this thesis plays out and the sector moves 10 times from current levels, a 3% allocation becomes 30% of your portfolio. That is an extraordinary outcome. At that point, you take profits, you reduce the position back to something sensible, and you redeploy the gains into assets with actual cash flows. You do not write it back down to zero because you fell in love with a story. And if you are wrong, if the FDA says no, if the trials fail, if the politics shift and RFK Jr. is gone and the executive order gets reversed, you lose 1 to 3% of your portfolio. That is painful, but it is survivable. You retire on roughly the same schedule. You do not have to sell the house. That is the entire framework. The specific risks here are real and worth naming explicitly. First, FDA approval is not guaranteed. It looks probable for Compass based on the Phase 3 data, but probable is not certain, and the FDA has surprised people. Second, these companies will likely raise capital before commercial launch, and that dilutes existing shareholders. More shares outstanding means your percentage ownership shrinks, even if the stock price rises. What's the share count? Third, even approved drugs can fail commercially if the reimbursement infrastructure does not support the price point. Johnson & Johnson proved the insurance system will pay, but each new drug faces its own coverage negotiation. Fourth, political risk is real. The current regulatory environment is favorable, and that can change budget differently for that possibility. Fifth, Johnson & Johnson is not passive. They have every incentive to lobby against reimbursement for competitive treatments. Large pharmaceutical companies have done this before, and they are very good at it. None of these risks make the thesis wrong. They make the position sizing discipline mandatory. Here is where I leave you. You now know what the trade is. You know the 3 companies, you know the math, you know the risks, and you know exactly how to size the position so that being wrong does not ruin you. And being right changes your financial picture permanently. The only question left is whether you actually do something with that information or whether you close this video and go back to whatever you were doing. And remember this conversation in 3 years, when you were watching someone else's account statement. Every major investment opportunity in the last 20 years looked uncertain, uncomfortable, and too early to the people who missed it. It looked like obvious common sense to the people who did the work, sized it correctly, and held through the uncertainty. The $400 billion market is open. The companies are small. The window is now you decide what you do with that. Subscribe to this channel. The next one matters just as much as this one.